Technical analysis is like looking for tracks in the snow. Elliott waves are one set of tracks that traders follow. Ralph Nelson Elliott discovered that market prices move in recognizable patterns. These patterns, called Elliott waves, repeat themselves on charts of all financial markets. Elliott wave theory helps traders understand market cycles and sentiment. By recognizing wave patterns, traders can anticipate market turns and make informed decisions. Just like a sailor uses ocean currents, traders use Elliott waves to navigate the Forex market. Imagine a wave crashing on the shore, followed by a smaller retreat. This natural rhythm of advance and retracement is mirrored in financial markets through Elliott waves. Elliott waves are divided into two main categories: impulse waves and corrective waves. Impulse waves consist of 5 subwaves that move in the direction of the main trend. These waves are labeled 1, 2, 3, 4, and 5. Waves 1, 3, and 5 are impulsive and move strongly in the trend direction, while waves 2 and 4 are corrective and move against the trend. Corrective waves are made up of 3 subwaves that move against the main trend. They are labeled A, B, and C. Corrective waves are typically more complex and challenging to identify than impulse waves, often taking on different shapes and patterns. Now that you understand the basic structure of impulse and corrective waves, let's explore how to identify them in the Forex market. The first step is to choose a currency pair and a time frame that you're comfortable trading. Next, begin looking for patterns that resemble the 5-wave impulse and 3-wave corrective structures. Look for strong, clear waves that move decisively in the direction of the trend. Remember that waves 2 and 4 in an impulse wave should retrace less than the previous wave. When you've identified a potential Elliott wave pattern, use technical indicators like Fibonacci retracements and extensions to confirm your analysis. Fibonacci levels often coincide with key support and resistance areas where waves are likely to reverse. It's important to note that identifying Elliott waves is a subjective process, and there's no foolproof method. Practice and experience are key to mastering this technique. The more charts you analyze, the better you'll become at spotting these repeating patterns. Section 4. Key rules for wave counting. To avoid misinterpreting Elliott wave patterns, it's crucial to follow some fundamental rules. Rule 1. Wave 2 cannot retrace more than 100% of wave 1. If a retracement exceeds the starting point of wave 1, it's not a valid wave 2. Rule 2. Wave 3 is never the shortest impulse wave. In a 5-wave sequence, wave 3 is typically the strongest and longest wave. Rule 3. Wave 4 does not overlap with wave 1. This rule applies to impulse waves. If wave 4 overlaps with wave 1, it suggests a more complex corrective pattern. Keep in mind that these are just a few key rules. There are many other guidelines and nuances within Elliott wave theory that experienced traders use to refine their analysis. Section 5. Elliott waves in action, a practical example. Let's examine a real-world example of how Elliott waves can be applied in Forex trading. In this example, we can see a clear 5-wave impulse pattern on the EUR-USD daily chart. Wave 3 is the longest and strongest wave, indicating a powerful upward surge. After the 5th wave completes, a 3-wave correction unfolds, signaling a temporary pullback in the uptrend. A trader who correctly identified this Elliott wave pattern could have entered a long position during the retracement phase, wave 2, and exited the trade near the top of wave 5, capturing a significant profit. Recognizing the corrective wave would have also helped the trader avoid entering short positions prematurely. Section 6. Pros and cons, navigating the waves. Elliott wave theory has its strengths and limitations. Pros: identifying market sentiment. Elliott waves offer insights into market psychology and potential turning points. Predictive power. Recognizing wave patterns helps anticipate future market movements. Applicable to all time frames. Useful for short-term and long-term trading. Cons: subjectivity. Different traders may interpret the same chart differently. Complexity. Mastering it takes time and practice. False signals. Not all patterns lead to profitable trades. Elliott wave theory is powerful but complex. Practice makes perfect.